Back in January, Janney Montgomery Scott issued a warning. If Congress doesn't reach agreement on spending cuts and tax hikes, the U.S. could lose its AAA credit rating. Today, S&P lowered its outlook on the U.S.'s credit to negative. Joining us now on the phone, Janney Montgomery Scott's chief fixed income strategist, LeBas. He's a Bloomberg best for his accuracy in forecasting, and he calls in this morning from Philadelphia. So, Guy, this didn't seem to be much of a surprise to you. Why is it a surprise in the market?
Well, I think the surprise really has to do more with the timing than anything else. I mean, we had a pretty good idea that the credit quality of the U.S. government was on kind of the downswing. We've known that for 6 months as kind of debt issuance has risen. Congress has had trouble cutting the deficit. But we didn't expect it to happen quite so soon. And I think the market's actually digesting the news reasonably well. I mean, if this had happened a few years ago, just imagine the mayhem that would have ensued.
You're looking at treasuries when you say that. I mean, some people have asked why there hasn't been more of a reaction in the treasury market. Is that because the Fed's in there and an active buyer today, or what?
No, you know, the reaction was initially fairly strong. We went from about a 1-point gain on the long bond, the 30-year Treasury note, to close to a 1-point loss. But I think because these credit concerns have been slowly emerging over the course of 6 or even 12 months, the impact hasn't been acute. You know, where the impact's really going to be more felt both today and I think in the long run is really in the equity markets and what we call risk assets like corporate bonds and the like.
Right, and some say, hey, maybe this really doesn't have to do with debt anyhow. Maybe this is just an excuse to hit the sell button today, take some profits.
Well, sure. I mean, it's a good time with the kind of rally we've had over the course of the last, again, 6 months or so. But we actually did a study back in January that focused on many sovereign ratings downgrades in countries like Japan and Spain over the course of the last decade. And what we found is that it tends to be the stock markets that get hit far worse than the country's bond markets. It's a little counterintuitive because obviously it's not the stocks that are getting downgraded, it's the country's bonds.
Yeah. Well, one place we are seeing active buying right now is gold. I mean, is that the new risk-off trade that replaces U.S. debt?
Well, in the event of a weakening U.S. credit quality, there is certainly a case to be made for stronger gold. You know, I would argue that the risk-off bet has actually moved overseas a little bit. If you take a look at Scandinavian countries, there's been a lot of aggressive buying of their debt, and they're AAA rated. Many of them have strong oil revenues and a fairly good history of conservative external borrowing.
That's interesting migration. I mean, elsewhere in Europe today, we're looking at Portuguese and Greek debt moving beyond those record highs in terms of yield.
Right, and that actually is kind of what made the markets somewhat volatile today, is we had Portugal and Greece having challenges over the weekend. That caused buying in treasuries early morning in the U.S. Then, of course, we have this bad news out from S&P, which reversed that in very short order.
I mean, what are you forecasting on that European front? The questions of restructuring and when keep bubbling up.
Absolutely. And I think many of the issues that European peripheral nations are facing are more structural. They're not the kind of things you solve by loaning them extra money for 2 or 3 years,
right,
particularly when it comes to Portugal and Greece, who have more deep-seated economic challenges than, say, Ireland, which is more about a shorter-term banking crisis.
Right. Well, Guy, near term, what should we be expecting in terms of the Treasury market in the United States and its ability to withstand political bickering in Washington? Do you think that the debt ceiling being raised is a non-issue at this point?
I think the debt ceiling will almost certainly be raised because the consequences of it not being increased are severe. And despite the political posturing ahead of the need to raise this debt ceiling, you know, we really believe that Congress will come around to that view. Our experience has been that despite all this bickering, when something absolutely needs to happen, it does get done. The question right now is whether S&P's action will kind of prod Congress into cutting the budget in the long term more aggressively.
Yeah. Are you betting that does happen?
I've become a political skeptic over the course of the last year or 2 years, unfortunately, so I'm going to have to wait and see on that point.
Okay.
What I will say is that there's some good bets to be made in the Treasury market as a result of this action.
But you're not changing your outlook in the near term?
We're not changing our major outlook. Economic conditions continue to proceed, and we don't feel that the U.S. government is likely to get downgraded, but it's definitely a bigger risk after this event.
Guy, thanks very much for your reaction.
Thank you, Margaret.